On January 20th, 2026, something broke in Tokyo. Japan's 40-year government bond yield shot past 4%, a level it had never touched in the nearly 2 decades since that bond was created.
A big sell-off in Japanese bonds as a result of this. Is the BOJ going to have to react? Do I need a lettuce?
Majority of the volumes traded every day are from foreigners. It's now over 50 to 60%, depending on which part of the curve. So you're seeing much more volatility in JGBs than we've seen in most of our careers.
The 30-year yield jumped 1/4 percentage point in a single trading session, the biggest daily move since 1999. To put that in perspective, in the Japanese bond market, a move like that normally takes weeks, sometimes an entire quarter. This one happened before lunch. One senior strategist at State Street called it one of the craziest days of his career, and he'd spent that entire career in Japanese bonds, a market people specifically chose because nothing ever happened. But what made January 20th truly alarming wasn't what happened in Tokyo, it was what happened everywhere else. Within hours of the crash, U.S. Treasury yields spiked. The 30-year Treasury pushed toward 4.93%, grinding closer to levels not seen since before the 2008 financial crisis. U.S. Treasury Secretary Scott Bessent personally called Japan's finance minister. And then, on January 23rd, something that almost never happens. The New York Federal Reserve started making calls to currency traders, asking them for quotes on the dollar-yen exchange rate. In financial circles, that's called a rate check. It's typically the last warning before a central bank steps into the market. The United States has only directly intervened in currency markets 3 times since 1996. The fact that they were even signaling it tells you how serious this was. So here's the question this video is going to answer. How did the most boring, most stable bond market on Earth, a market where nothing happened for 30 years, become the single biggest threat to the global financial system? And why does a bond crash in Tokyo matter for your mortgage, your stocks, and your retirement account halfway around the world? It starts with a trap that Japan built for itself, and that the rest of the world walked right into. To understand how we got here, you need to go back to a time when Japan looked like it was about to take over the world. In the late 1980s, Japan was the most economically confident country on the planet. Its factories were outcompeting American manufacturers in everything from cars to televisions. Its stock market was on an unstoppable tear, and its real estate market had gone completely insane. At the peak, land prices in Japan had increased 5,000% since 1956. The total value of Japanese real estate was estimated at 4 times the value of all real estate in the United States, despite Japan being 25 times smaller. And this is the number that really puts it in perspective. The grounds of the Imperial Palace in central Tokyo, about 1 square kilometer of land, were estimated to be worth more than the entire state of California. Then it all collapsed. The Bank of Japan raised interest rates in 1989 to cool the speculation, and the bubble burst. The Nikkei stock index dropped over 60%. Land prices in major cities fell by as much as 70% and never recovered. Japan didn't just have a recession. It entered what economists now call the lost decades, a long, grinding period of falling prices, stagnant wages, and economic growth that barely moved for more than 20 years. So how did Japan try to fix it? With the most aggressive monetary policy the world had ever seen. The Bank of Japan cut interest rates to 0 in 1999. When that didn't work, they went negative. You were literally paying the bank to hold your money. And when even that wasn't enough, they started buying their own government's bonds on a massive scale. This is called quantitative easing, and Japan didn't just dabble in it. They went further than any country in history. In 2013, under Prime Minister Shinzo Abe and his policy package known as Abenomics, the Bank of Japan committed to buying 60 to 70 trillion yen worth of bonds per year. The next year, they raised it to 80 trillion. By 2016, they introduced something called yield curve control, essentially promising to keep long-term interest rates pinned near 0 no matter what. The result? The Bank of Japan ended up owning more than half of all Japanese government bonds. As of December 2024, the central bank held 46.3% of the total, the single largest holder by far. At its peak, the share exceeded 53%. Think about what that means. The country's central bank became the biggest lender to its own government. And because it was buying so aggressively, nobody else needed to worry about whether Japan could afford its debt. Interest rates stayed near zero. Borrowing was essentially free. So Japan kept borrowing, and borrowing, and borrowing. By the end of March 2025, the national debt had reached 1,324 trillion yen, roughly 235% of GDP, the highest of any developed nation on Earth. Now here's where the rest of the world enters the picture. When a country keeps its interest rates near zero for decades, it doesn't just affect that country, it creates an opportunity for everyone else. Imagine you could walk into a bank and borrow money at almost no cost, no real interest, no real penalty, and then you take that money, convert it into dollars, and invest it in something paying 4 or 5%. You pocket the difference. That's basically free money. That's what hedge funds, banks, and institutions around the world did with Japanese yen for more than a decade. It's called the yen carry trade. You borrow in yen because it's cheap, you invest in US treasuries, tech stocks, emerging market bonds, whatever pays more, and you profit from the gap. As long as the yen stays weak and Japanese rates stay low, it works beautifully, and it got enormous. By October 2025, BCA Research estimated that the value of yen forwards held by global hedge funds and trading firms had reached 35 trillion yen. The total value of all yen forwards, swaps, and currency swaps hit 2,281 trillion yen. That's not a rounding error. That is the financial system itself being wired to Japan's cheap money. Trillions of dollars in global investments, from the stocks in your retirement fund to government debt in developing countries, were being funded, directly or indirectly, by borrowed yen. Japan had become the world's ATM. And nobody thought to ask what would happen if someone turned it off. We actually got a preview of what happens when Japan's ATM starts malfunctioning. Most people just didn't realize what they were watching. On July 31st, 2024, the Bank of Japan raised interest rates. Not by a lot. From basically 0 to 0.25%. A quarter of 1%, that's it. The kind of move that, in any other country, would barely make the news. What followed was chaos. Within days, the Japanese yen surged. That might sound like a good thing, but for everyone who had borrowed yen to invest elsewhere, a stronger yen meant their loans suddenly cost more to repay. So they started selling. Whatever they had bought with that borrowed yen, they dumped. Tech stocks, bonds, crypto, everything. The selling fed on itself. The more people sold, the stronger the yen got, which meant more people needed to sell. On August 5th, Japan's Nikkei 225 fell 12.4% in a single day. The worst crash since Black Monday in 1987. It wasn't just Tokyo. South Korea's market fell over 8%. Taiwan dropped 8.4%. The S&P 500 fell. Bitcoin crashed below $50,000. Over $5 trillion in global market value was wiped out in roughly 24 hours. And then, almost as quickly as it started, it stopped. Markets bounced back. The Nikkei had its biggest single-day gain since 2008 the very next day. People moved on. The headlines shifted. But the lesson was right there, sitting in plain sight. A quarter-point rate hike in Tokyo, the smallest possible adjustment, had shaken the entire global financial system. And almost nobody stopped to ask, what happens when the adjustments get bigger? 5 months later, the Bank of Japan raised rates again, this time to 0.75%, the highest level in 30 years. And then, in January 2026, the political situation made everything worse. Japan's Prime Minister, Sanae Takaichi, the country's first female leader and a devoted follower of the late Shinzo Abe's economic playbook, called snap elections. To win votes, she made a promise that sent bond traders into a panic. She would suspend the consumption tax on food for 2 years and push through a spending package worth 21.5 trillion yen. That's roughly $115 billion in new commitments on top of a government that was already spending at record levels. Here's why that terrified the bond market. Japan had just approved a record budget of 122.3 trillion yen for 2026, about $785 billion, and look at where that money goes. Social Security spending hit 39.1 trillion yen because the population is aging fast and retirees need pensions and health care. Debt servicing, just paying interest and rolling over old bonds, hit 31.3 trillion yen. The first time it crossed the 30 trillion mark. Add those two together, and you get nearly 60% of the entire government budget going to pensions and interest payments. Before a single road gets built, before a single school gets funded, before a single soldier gets paid, 60 cents of every yen the government spends is already spoken for. And it's getting worse. The finance ministry had to assume a 3% interest rate when budgeting for new borrowing, up from 2% just 1 year earlier. That's like watching the interest rate on a gigantic national credit card jump by 50% in 12 months. Except the balance on this credit card is 1,324 trillion yen, roughly 235% of the entire economy. So when Takaichi announced she wanted to cut taxes and spend more, the market's reaction was immediate and violent. That was January 20th, the day we opened this video with. The 40-year bond yield exploded past 4%. The 30-year yield moved a quarter point in hours. One analysis found that just $170 million in 30-year bond sales and $110 million in 40-year sales, tiny amounts in a $7.3 trillion market, triggered $41 billion in value destruction across the entire yield curve. The contagion was instant. U.S. 30-year Treasury yields surged toward 4.93%. U.S. Treasury Secretary Scott Bessent, speaking at the World Economic Forum in Davos, publicly pointed to Japan as the source of global market stress. Yields on 30-year U.S. Treasuries hit their highest level since September. One prominent analyst put it bluntly, Japan has been the world's financial shock absorber for a generation, and that role has abruptly ended. In 2022, the British Prime Minister announced a package of unfunded tax cuts, and the bond market destroyed her government within weeks. Japan's debt-to-GDP ratio is roughly double Britain's, and Takaichi was proposing something similar, except on the world's largest government bond market. So you might think, okay, the market panicked, the election happened, maybe Takaichi backed down and things calmed down? The opposite happened. On February 8th, 2026, Takaichi didn't just win. She won by the largest margin any single party has achieved in Japan since World War II. Her party took 316 seats, crossing the supermajority threshold. That means she can override vetoes from the upper house. She doesn't need coalition partners. She doesn't need to negotiate with anyone. In modern Japanese politics, she is functionally unchecked, except by one thing, the bond market. And that's where this story turns from alarming into something closer to a trap with no exit. Because the people holding Japan's bonds can't really sell them, and the government can't really stop borrowing. Everyone's stuck. Here's why. Unlike the United States, where foreign investors hold a huge chunk of government debt, Japan's bonds are overwhelmingly held at home. As of December 2024, 88% of the government's debt was held domestically. The Bank of Japan holds the biggest slice. After that, it's the country's insurance companies, its banks, its pension funds. These are the same institutions that manage the savings and retirements of ordinary Japanese people. So what happens if yields keep rising and bond prices keep falling? These institutions take losses on their own portfolios. In early 2026, unrealized losses on domestic bond portfolios at major insurers like Dai-ichi Life were estimated at 9 trillion yen, roughly $60 billion. But they can't just dump everything and walk away. If they sell, they push prices down further, which means even bigger losses for themselves and every other domestic institution holding the same bonds. It's been described as mutually assured destruction. Everyone is holding on because the alternative is everyone losing at once. And here's the layer underneath all of that. Japan doesn't just have a debt problem, it has a people problem. The country's population has been declining for 16 consecutive years. Last year, more than 900,000 more people died than were born, the biggest annual drop on record. Nearly 30% of the population is now over 65. The fertility rate hit a record low of 1.15 children per woman in 2024, far below the 2.1 needed just to keep the population stable. Official projections say Japan will shrink from 123 million today to 87 million by 2070, with nearly 40% of the population elderly. What does that mean for the debt? Fewer workers means less tax revenue. More retirees means higher pension and healthcare costs. The tax base is shrinking, while the obligations are growing. And unlike a financial crisis, which can theoretically be solved with policy, you can't fix demographics in a decade. Babies born today don't start paying taxes for 20 years. Robin Brooks, a senior fellow at the Brookings Institution, has been one of the loudest voices, arguing that Japan is already in a debt crisis. It just doesn't look like one yet. His argument is that the Bank of Japan's continued bond buying is masking the real stress. The crisis isn't showing up in yields because the central bank is still absorbing the selling pressure. Instead, it's showing up in the currency. The yen hit an 18-month low against the dollar in early 2026. Brooks put it this way: markets think risk of a debt crisis is rising sharply. Yen depreciation won't stop until yields are allowed to rise far more, forcing the government to pursue fiscal consolidation. Japan needs to stop being in denial. So the bond market can't crash because domestic holders can't afford to sell, and the government can't stop spending because pensions and debt payments eat 60% of the budget, and the population is aging faster than any developed country in history. And the central bank can't keep buying forever because it already owns nearly half the market and inflation is running above target. That's the trap. So why should you care about a bond market in Tokyo? Because Japan is the single largest foreign holder of U.S. treasuries, roughly $1.2 trillion. Japanese investors hold $12 trillion in foreign assets worldwide. If yields at home keep rising, that money has a reason to come back. Less demand for American debt means higher yields, which means more expensive mortgages, car loans, credit cards. You don't need to own a single Japanese bond for this to reach your wallet. Then there's your portfolio. A massive amount of money in U.S. tech stocks and high-yield investments was funded by cheap yen borrowing. BCA Research called the carry trade a ticking time bomb in February. When it unwinds, the selling is violent. We saw it in August 2024, when a quarter-point rate hike erased over $5 trillion in global market value in a single day. That was a tremor. The carry trade is still out there, still enormous, and the conditions that could set off a bigger unwind haven't gone away. They've gotten worse. And the uncomfortable truth nobody wants to say out loud: Japan isn't unique. It's just first. Global public debt is expected to cross 100% of global GDP within 3 years. The US is running trillion-dollar deficits. The UK's long-term borrowing costs are at generational highs. Japan is the test case. If the bond market can force discipline here, on the most domestically funded, most institutionally stable debt market in the developed world, it can do it anywhere. And right now, the war between the US and Iran is making it all worse. Japan imports over 90% of its energy. Every barrel costs more. That feeds inflation, which pressures the Bank of Japan to raise rates, which makes the debt more expensive, which widens the deficit. It's a loop, and the war is spinning it faster. 30 years, Japan was the quiet room in a noisy house. So quiet that the entire world built its financial architecture on top of it without thinking twice. Hedge funds used it as a cash machine. Governments used it as proof you could borrow forever. Nobody worried about Japan because there was nothing to worry about. That era is over. Whether this becomes a full crisis or a messy transition, nobody knows. People have predicted a Japanese debt crisis for 20 years, and betting against their bonds was so consistently wrong that traders named it the Widowmaker trade. Maybe Japan finds a way through again, but this much has changed. The central bank is stepping back. Inflation has run above target for 4 years. A prime minister with a supermajority wants to spend more. The population is shrinking by almost 1 million people a year. And the world that quietly plugged itself into Japan's cheap money is only now realizing what it means when that plug gets pulled. The $7.3 trillion question isn't whether Japan's bond market will move. It already has. The question is whether the rest of the world is ready. I want to hear where you land on this. Is this the crisis that finally arrives? Or is Japan the crisis that never actually comes? Drop it in the comments. If this is the kind of thing you want to understand before it's front page news, subscribe to Quiet Power and hit the bell. We go deep on the stories that actually move markets. See you in the next one.